So thank you very much for your interest in my paper, Future Prices Are Useful Predictors of the Spot Price of Crude Oil. This is a reproduction of the presentation given at the Canadian Economic Association annual meetings this year, and this paper is forthcoming in the Energy Journal. So the core question of this paper is, are future-based forecasts useful for predicting the real price of crude oil? Okay, so we're interested in forecasts of monthly real price of crude oil. And the literature, the consensus in the literature is that they're not particularly useful. And the literature has arrived at this conclusion by constructing futures curves of monthly average real prices using average future prices, and then comparing their forecasts against the monthly average real price. And what we point out in this paper is that this approach is not suitable because the data is temporally aggregated. Okay. So the EIA, the Energy Information Administration, publishes the WTI and Brent price as a monthly average of daily closing prices. And we've known since the 80s that averaging over any values can result in a substantial loss of information when forecasting. And we also know that when we evaluate the usefulness of the forecast, that we need to compare against the end of month price. And this is true regardless if the series of interest that we're forecasting is averaged or not, or in real terms or nominal. So in this paper, what we do is we apply selective sampling methods to future-based forecasts. So we avoid aggregation and try to extract the maximum amount of information. And then we compare our forecasts against the end of month no change benchmark. So let's jump right into the standard model that's used in the literature. This is basically a spread model where we're interested in real-time forecasts of the future monthly price of crude oil, H periods ahead. And we apply the spread between the futures price at horizon H with the current spot price. And we also adjust for inflation. And what we use here for the futures and spot price in the literature, this has the sampling of these futures and spot prices has been the monthly average. So they've taken the monthly average of the futures price and the monthly average of the spot price for real price forecasts. Okay, and of course, this is adjusted for inflation because this is a real forecast. And however, when nominal forecasts were conducted, so we're interested in forecasting the end of month nominal forecast, then Alquist and Killian used the end of month futures curve and the end of month spot price, not adjusting for inflation, which avoids the temporal aggregation for nominal prices. And what we are arguing is that we should be doing the same thing for real prices in the sense that we should be sampling end of month futures and end of month spot prices, even when we're interested in forecasting future averages of the real price. So this is the main findings of this paper. So what we have here is for different horizons in month, so 1 month to 5 years ahead, we have the mean squared prediction error ratio. So this is a measure of precision. So values less than 1 are improving upon the average price no change forecast, which is a good thing. And then we have our success ratio, which is our measure of directional accuracy. So values above 0.5 are improving upon random changes in the direction of the price. And what we have here is that we have a replication of the two main forecasts in the literature. One is for nominal end of month forecast using end of month futures prices. And what you see here is that at short horizons, they are able to outperform the end of month no change forecast, but not necessarily significantly so for MSPE or for the success ratio. But what we can see here is that at longer horizons of basically 9 months and beyond, actually future prices have become quite useful at forecasting even end of month nominal values. Okay, and we find this because of at horizons of about 1 to 2 years because we've updated the evaluation sample. So this is true over the last 10 years, as well as since these last papers have been published, the futures contracts have actually gone out more into the future. So we were able to look at horizons of 3 to 5 years. Okay, so at these longer horizons, particularly of interest to policymakers and long horizon investment decisions, actually future prices are incredibly useful. Up to 40% reduction in the in precision, or 40% gains in precision, and up to 90% improvements in directional accuracy, which is pretty phenomenal. Okay, so the second replication we're going to look at is forecasts of future average real prices, where the futures curves constructed using average futures prices. And again, we see here that they're not particularly useful at short horizons. But actually, again, we see that we get actually some large improvements in both precision and directional accuracy at 9 months and beyond. Okay, so at longer horizons, these even when averaging, we get a tremendous forecast precision, over 55% improvements in directional accuracy, and again almost 90% improvement for directional accuracy. So what we do is then we construct these same forecasts, so the same forecasts of real average prices, but we don't average the futures data. So just like when we constructed our nominal forecast, we just use end of month futures prices to construct our real price forecast. And when we do so, we basically avoid the loss of information from aggregation. And then you can see here that we have a tremendous improvement in forecast accuracy at short horizons. Okay, so this is over 40% improvement in the mean squared prediction error, the one step ahead, and in directional accuracy. And the gains are robust for almost all forecast horizons, and at both long and short horizons. Okay, so these are absolutely substantial forecast gains. The largest model-based forecast that we had surveyed in another paper at the 1 month ahead was 25% improvements in the mean squared prediction error. So these are twice as good as the best model that are out there in terms of forecast accuracy. The other thing is that these are, at the short horizons, have been robust for 100% of the evaluation sample, right? So it turns out that even in the sample originally considered in the previous literature, that if we constructed our future-based forecast using end-of-month values, we would have always been able to reject the average price no change forecast. We've always had forecast improvements, okay? The reason we weren't finding forecast improvements because we were using average future curves and we had this loss of information. And then again, at the 12-month horizon, we have been seeing improvements relative to the end of month no change forecast and the average price no change forecast over the last 15 years. So basically, we had a deterioration in forecast accuracy at these longer, long horizons at the 1 month ahead during the run-up of oil prices in the mid-2000s. But since then, and over the last 15 years, future curves have been very, very useful, both in terms of the mean squared prediction error, as well as directional accuracy, suggesting that these gains have been quite robust over time. So one of the things we look at in this paper is why have we been seeing these long horizon improvements in forecast accuracy? And we find that the horizons that have the largest gains in forecast accuracy coincide with sort of financialization. So deepening in the volume and open interest in the futures curve. So as future curves have deepened, as there's been more participants in the market, if anything, it suggests that there's been more information or more predictive information, or more information that's useful for prediction. So we look at a number of extensions and robustness in the paper. And so I'm showing here in this table, so I flipped the axis. So now I have the horizon on the horizontal axis, and I have different future-based forecasts that I'm considering in the rows. And again, I have both the mean squared prediction error as well as the success ratios. So the end of month futures curve forecast, this is our baseline futures forecast. It turns out if we just use the futures price exactly and don't use the linear approximation by using the spreads model, we get very similar results. Any amount of forecast, any amount of averaging over the futures, end of month futures prices is going to deteriorate forecast accuracy. And we find this very consistently, and this is also consistent with what we'd expect theoretically. Similarly, if we use the end of month or the end of contract value or sort of a contract average, we would get a lot less information out of the futures curve. And this is quite intuitive because the last observed futures price contains, if markets are efficient, they contain all the available information available to traders in that market. Okay, and so as soon as we start averaging over daily prices in the past, we're averaging with prices that have old information in them. So the more we average, the more old information, the less efficient our futures will be, right? So we always want to use the last observed futures price, which is, in our case, is the end of month closing price in the futures market. And then the last thing we look at is when we use the end of month futures price, the front contract, so the first contract actually refers to a date that's closer to about 7 weeks ahead, so closer to 2 months ahead. And so what we do is we realign the front contract with the 2 month ahead forecast, and then impute the 1 month ahead forecast using the average curvature in the futures curve. And what we find is very robust gains in forecast accuracy at short horizons. Okay, so they are small. So when we adjust the futures curve, we again increase our forecast precision just by a little bit relative to not doing this adjustment. But these gains are robust for like over 96% of potential ending points of the forecast evaluation sample, suggesting that these adjustments in the front contract are going to be particularly useful. So we also extend the futures curve. So we use Brent futures prices to construct real Brent forecasts. We find that they also are very robust and very large gains at short horizons. And we also see the tremendous gains at longer horizons. However, the Brent market has about twice the open interest in volume as the WTI. And maybe that's one reason why we don't see necessarily significant gains at these medium horizons. In the paper, we also extend this to the refiner's acquisition cost, where there is no futures curve or there's no futures market, but we apply the WTI spread to just a raw WTI spread to the refiner's acquisition cost. And actually, we find that this is an incredibly good forecast. Again, much larger than what we've seen in the literature, and then significant at all horizons. And in fact, this one of the reasons why, at least in terms of the mean squared prediction error, this isn't as large of a gain as the WTI is, because this is real-time data, and the refiner's acquisition costs are subject to quite large revisions. And of course, needs to be nowcasted. But if we use ex post revised data, actually the forecast gains are very consistent. Okay, suggesting that for manufacturers, this would be a very good forecast for their input costs. However, everything that we've seen so far in this paper is comparing against the average price no change forecast, because this is consistent with what the literature has done. They've constructed forecasts of future monthly average real prices and compared against the monthly average no change forecast. However, this is not a test against the null of no predictability if the underlying data, if the daily real price of crude oil follows a random walk. Okay, and so what we do here is we can compare the forecasts to the end of month real price, no change forecast. So this is the real price on the closing, on the last trading day of the month. So the closing price on the last trading day of the month in real terms. And we compare this to the average price, no change forecast. And again, we see these very large forecast gains, right? So this was the point of Working's 1960 paper that, to avoid spurious predictability, we actually need to compare against the last observed disaggregated observation. And we've argued in another paper that this is true regardless of whether you're forecasting future average prices or not, or nominal in real terms. And so when we look at that, we do see these exceptionally large short forecast gains that are significant up to 1 year ahead. Okay, so this sort of questions whether or not our forecasts are useful. It turns out they are at short horizons, and they've been able to outperform the end of month no change forecasts, and very robustly so. So both in terms of directional accuracy, as well as the mean squared precision, they've actually outperformed for 100% of the evaluation sample for this sample at the 1 month ahead. Okay, so they are useful at short horizons, and they are very useful at long horizons, right? So the end of month no change forecast only really has improvements over the significant improvements for the sample size for up to 1 year ahead. And so at longer horizons, again, we see this absolutely enormous improvement in forecast accuracy coming from the futures curve. The other thing is we can compare it to model-based forecasts that are sort of the benchmark in the literature, including an autoregressive model with 12 legs, or a vector autoregressive model of the global market for crude oil. And when we replicate those findings, we find that there has been a deterioration in forecast accuracy of those models since they've been published. And this is consistent with the findings of those authors and other papers. And so those models never really came close to outperforming end of month no change forecast, or come close to what the futures curve could have produced. The other thing we look at is the energy information forecasts. So the EIA produces forecasts. The caveat here is this actually is not a real-time forecast. They have information by the time that they publish their forecasts, they have 2 to 3 weeks of extra information. And so despite almost a month more of information, they could have just done better by using last month's future prices in terms of comparatively relative to the way that the EIA is producing the forecast. So again, futures curves are credibly useful at longer horizons relative to the end of no change forecast, and do improve upon them for 100% of the valuation sample at the 1 month ahead and relative to other benchmarks. So in the paper, we go in and look at nominal average price forecasts and different assumptions to CPI. The results are, again, very robust. Future prices are very useful. The forecast gains are even larger for quarterly or annual data. And we don't find any consistent additional gains from doing real-time estimates of the storage model. So the findings of this paper call for reinterpretation on the usefulness of future-based forecasts. It turns out future-based forecasts have always been useful at outperforming the average price no change. And now they are incredibly useful at longer horizons, as well as showing some ability to outperform the end of month no change forecast quite robustly at the 1 month ahead. When we construct future-based forecasts, regardless of whether they're nominal, real, or averaged or not, we should be using the end of month closing price to avoid the loss of information. So using this period end price sampling method. The informational content has improved at longer horizons. This is consistent with the deepening of the market. And we are able to show that, as we are the first paper to show that, as that information has recently come available. And I think there's pretty profound policy implications for this. So first, these exceptionally large improvements in forecast accuracy at longer horizons are the horizons of interest to policymakers and for long-term investment decisions. suggesting the futures curve is actually a very good way of constructing forecasts and outperform other benchmarks, including the optimal no change forecast under the null of no predictability. And it also, I think, has suggests that when we do construct our forecasts, we should be using the last available information. So we should try to avoid as much information delay between when we extract the information from the futures curve and then when we actually make decisions based on those forecasts. So thank you very much for your time. And if you're interested in this topic and in explorations for model-based forecasts, please check out my other papers. Thank you.